Hello, Nate Scott here. It's right here at the top of the hour. We're going to go ahead and get started with today's webinar. Today is going to be a webinar that's certainly more analytical, so I hope that for those of you who are here, you're more the analytical type, because we're going to be discussing something that's a little bit detailed, and that would be policy loans. And for those of you who have been around infinite banking for a while, I think this can help clear up some confusion that you may have had in the past. If you already have a policy, have been taking loans from it, kind of want to know what's actually going on behind the scenes. That's really the goal of this webinar. For those of you who don't have a policy yet and are still searching, maybe this will help answer some of your questions. But I wanted to have a couple of warnings, I guess, as we get into this. First off, especially for those of you who are kind of new to this, it may do more harm than good to go into this, because I'm going to be very detailed, and there's going to be a lot of things that I'm going to say that may or may not make sense to you, because I'll be using words that you might not be familiar with. So I would encourage you to watch this. It is going to be recorded. Maybe watch this, get some ideas, go take our beginners course, which is online for free. Get more accustomed to the words I'll be using, and then maybe come back and watch it a second time to really let it hit home. A couple other things on this. I'm going to be going over some actual life insurance policy illustrations. For those of you who do have one already because you own a policy, you know they're not the most simple document to read. So with that being said, I know it's very easy to do whenever I pull up something up and there's all these things on the page, to try to go out and understand what all the numbers mean and where everything's coming from. I'm going to isolate what I'm going to cover today, because the whole goal of today is to detail what happens when you take out a policy loan. What happens to the cash values of your policy? What about the interest that you're going to pay them? Do we recapture the interest, or does it go away? We're going to really try. How do you pay yourself back, and things? How do you improve the policy by doing so? We're going to be going through all those questions, only detailing the policy loans. So there's things about the policy's design and some of the numbers that are going to be on the page that really do not apply to our discussion today. So I'm not going to cover them, and I'm not going to answer any questions on them, because that is not the goal for today. Today is just discussing how policy loans work. So there's going to be some givens in these examples that I'm not going to go into a great detail everything, except for what pertains to this conversation today. So with that being said, I'm going to go ahead and get started with the webinar. My name is Nate. I've been here for sharing this for quite a long time. I don't even know how many years now. Many of you may have spoken to me. Many of you have heard our podcast or our course. Today's going to be a little bit more detailed. I hope you enjoy it. To start off with, there's one principle that you really have to be in line with in order for any of this to make any sense, it might be able to make sense without it, but it's certainly something that's very useful. And that is the overarching premise of infinite banking. And that is something that Nelson Nash, who wrote the book Becoming Your Own Banker, he started the concept, the infinite banking concept, back in the year 2000 when he wrote his book. And that's really what we call it, the Bible of banking. It's what really started this whole thing off. And he mentions something that's very crucial, and that is the fact that you finance everything that you buy. You finance everything that you buy. You might be sitting there saying, "Nate, no, I don't. I pay cash for things. I don't like taking loans out." Well, I'm here to tell you that whether you borrow money or pay cash for something, you really are financing it. In other words, there really is two main ways for people to pay for things. You can either pay cash on one side, or you can borrow. Those are the two main ways that you can purchase something in today's day and age. You either save up money and pay cash for it, or you borrow it. We all understand with borrowing, there's a method of finance. In other words, when you borrow money to purchase something, you know that they're probably going to want interest on that. They're going to want you to pay it back with interest. There's not free money out there typically. And so we can all understand that when you borrow money, you pay interest. The thing about, a lot of times we want to pay cash for something because we don't like paying interest. That's the real key. But the issue is, when you pay cash, you lose all the interest that you could have earned. So on the cash side, you either lose interest, or on the borrow side, you pay interest. That's the only two way to finance something. And if we put real numbers on it, if you were to go out and buy a car tomorrow, let's say it's $25,000 to buy the car, you have two options. You can either pay cash and write a check for $25,000, or you can borrow the $25,000 to pay for it. If you borrow it, we all understand they're probably going to make you pay back more than 25 grand. They're going to, when you finance the purchase that way, it's going to cost you more than what you borrowed. They're going to have, you might have to pay back 30,000. But whenever you pay cash for the car, you've also paid interest in a sense. In other words, the money that you had, the cash that could have been deployed to earn you money, is now gone, and it can never earn you another dollar again. And so on the one side, we lose interest we could have earned on that money. On the others, on the right side, we have to pay interest for using their money. But regardless, we really do finance everything that we buy one way or another. You may have heard that being called opportunity cost is the economic term for what we're talking about as well, opportunity cost. And what's cool about the policy is that it kind of lumps these together in one place and makes it really systematic. A lot of people, when they go out and they purchase something, what happens is, and we've discussed this before, is there's essentially, we call this the $0 line. And this is where you're broke. Okay, it's where you don't have any money. And there's two methods to finance it. You can either pay cash for it, which really means you built up some money. And then whenever you actually have enough money to, let's say, buy a car, we then liquidate the account. And we start back over, and we build it back up. We liquidate the account. We start back over. And we can continue doing this until we find out that we end up right back at the $0 line. That's what paying cash is. We could do the opposite of that. And we can not save up money, and we can just borrow, and then instead of building up money to pay cash, all we're doing is kind of getting ourselves back to zero, where we're paying off the debt. And we get back up, and then we're done maybe buying the car, and then we go back out and we do it again, and we're just trying to get back up to the zero line. But really on both scenarios, we're really back at zero when it's all said and done. What a policy allows you to do is a little bit different. And that whenever, and we're going to get into this with the real numbers of the policy, is what it allows you to do is kind of get off that line. Because if we go back up maybe to the cash spot here, the very first time that we bought, used our cash, the compounding of the policy actually continues to go up based on that amount. So as we're instead of dropping down to zero, we're now building back up that account. But when we're done paying it off, we're going to be a little higher than we were beforehand. And then and then we can do it again, and we're going to be a little higher than we were beforehand. And that's what I'm going to show you how to do. So the overarching principle is that you finance everything that you buy. This policy is really a way to do that in a very systematic way, and I'm going to share that with you. Remember, you either pay somebody else interest so that you can use your money to make money, or you give up your money. It can't make you money anymore, but then you avoid paying interest. Those are the only two ways. And inside a policy, that's actually true, by the way, people. For those of you who don't know, there is a way you can actually borrow against your policy. You can take a loan against it, or you can take a withdrawal from the policy. You have that choice. If you are terrified of paying interest, there is a way to withdraw money from a policy. If you take a withdrawal from your policy, then all the cash value that you took out is no longer going to be earning you a dime. It's out of the policy, just like this. You're back to zero, and you've got to build it back up, and you're back to zero. Whenever you borrow from it, all the money actually stays in the policy, and you pull out a loan against your cash value, using it as collateral. So 100% of the money continues to earn. On the flip side, though, you are going to be paying interest on that loan. The question is, which one makes more sense? And so that's what I want to show you today. I'm going to pull up a policy illustration here to go over that with you today. Now, as I mentioned at the very beginning, there's a lot of columns here. I want to try to focus on the things that make sense. And always keep in mind here that the whole purpose of building this example was just to try to isolate, and as simple as I could figure out how to do it, how a policy loan works, how repaying it works, how the cash value grows, how the interest works, and everything like that. So there's going to be a lot of things on here that we're not going to cover, so please bear with me. In this example, I had to build a policy, and I just chose to pay a premium on this policy of $15,000, and I did that for 7 years. And actually, you'll see in a moment, you'll see that I'll show you some things, by the way, that'll help you make sense of it. But that's really what I did on this policy. The other column that we care about is this total net cash value. You'll see at year 7, whenever I was done building up the policy, I had $102,000 of cash value. I really just built a policy. I didn't use it at all for the first 7 years in this example. I just kind of paid premiums, built it up. My goal was just to build up a policy to get real close to $100,000. That's a nice round number. And then I was going to take out all the money in a loan, pay it back, paying the loan interest and everything, and see what happens. That's really what we're trying to do here. So, but a couple of things to make this work is the other column that we really need to focus on is this annual outlay column, as well as this loan balance column. So these are some of the main things that we're going to focus on today. And so whenever we built this policy up, we did it for 7 years. I actually wanted to then turn off the premiums of this policy, or I really wanted to have the policy pay for itself. And I did that because, not that I suggest people do that. In fact, a lot of times people hear our example and they'll see that at some point we stop paying premiums. The reason in our examples that we stop paying premiums a lot of the time is simply so that we can isolate the loans and isolate the use of the policy. In this case, I wanted to build up the policy. I wanted to get right at about $100,000, and then I wanted to stop the premiums, take out a big loan, and pay it back, so that the only money that was coming back into this policy was the money that I was paying back on the loan. I didn't want to pay in any extra premiums, because if I was to pay the premiums into it out of my pocket, that's going to skew the numbers a little bit. And what I mean by that is, now I not only have the money that I'm paying back on the loan to account for, but now I've got these premiums to account for. And the premiums are going to help boost the policy even faster. So essentially it would have made more money than what I wanted to show. I just wanted to show a policy where we stop paying premiums, we take out a loan, we pay it back, and the only money that comes back in is the money it takes to pay the loan balance. That way I can isolate what that loan did without me paying any more money into the premium, and see how the policy grew, assuming no more premiums are paid. All I did was pay a loan back. I hope that makes sense. As I said, this is going to be recorded. It'll be sent out a link in a day or two, and you guys can watch it again to get more details on it. But all of that was prefaced to simply say, you'll see this column here called paid up addition surrender. Paid up addition surrender. What that really means is that I start surrendering or withdrawing. That's the fancy word for withdrawal in the insurance industry, is the word surrender. It just means a withdrawal. I started taking out $6,000 a year to pay the premium of $6,000. So what I'm trying to mention there is that the outlay out of pocket goes to zero. In other words, the policy is paying for itself. It's withdrawing $6,000 out of the policy to pay the premium each year, so that I don't have to come up with it out of my pocket anymore, and I can just focus on the loan. And you'll see that, by the way, with that outlay column. We take a loan, we pay it back, but after we're done paying the loan back, and I'll share that details with you, you'll notice that the outlay here goes to zero. Even though it says there's a $6,000 premium ongoingly, the outlay goes to zero. That's because we're not paying into the policy at all. The policy is just withdrawing $6,000 a year to pay the premium. That way, I don't have to come up with any money out of my pocket to pay it. All I have to do is see what happens with my loan. So that's the details here, and I think it'll all come together here in a moment as well when I get into it. So remember, all I was really trying to do was build up the system just so I can get to where I'm at right now. And that is, I'm going to take this cash value that I have of $102,000, and I'm going to take out a loan. I actually took out a loan of $100,000 in year 8. And I'm going to pay it back over 5 years. And I'm not going to pay any premiums. I'm just going to pay the interest. And I'm going to pay the principal and the interest on the loan and pay it back, and we're going to see what happens here. So if you look at the outlay column right here, you'll see that in year 8, it doesn't say a negative 100,000. It says negative 77,786. And the reason for that is because in the software, what you have to do is it's shorthand for the fact that we took out a $100,000 loan from our policy in year 8, but then we immediately started repaying that policy loan. And you'll see in years 9, 10, 11, and 12 that the outlay is $22,213 and some change. So if you took 100,000 and subtracted 22,213 from it, essentially negative 77,000 is shorthand for saying I took a negative 100,000. I took 100,000 out of my policy, and then throughout the course of that year, I also paid back in $22,213.11. And so it's just shorthand for saying I took out 100, I put back in 22,213. So that year was negative 77. And then in year 9, I paid 22,213, year 10, 11, and 12. And so that's 5 years of paying back this policy loan. And that's all I did. I didn't pay any premiums. That's all the outlay that happened was just me pulling out 100,000 and then paying it back with $22,213 a year. And so I'm going to bring up a calculator. I want to know how much total did we pay back on this policy loan. So let me pull this calculator up. And I'm going to take essentially the $22,213, $22,213.11, and we made that payment back to our policy each year for 5 years. So I'm going to multiply that by 5. And so what this tells me is that all the payments added together equal $111,065. So what this tells me here is that I paid back $100,000 to the principal of the policy. In other words, I borrowed 100 grand, I paid back 100 grand, plus I paid back $11,065 of interest on the policy loan. Now that all went just straight to the insurance company. I paid $11,000 of interest on the policy over that 5-year time period to repay this policy loan. However, now we need to see what happened inside the cash value of this account. You'll notice that it went from, remember we had $102,000 in year 7, right before we took out our big loan. And by year, what is that, year 12? Yeah, year 12 is when we finally had the loan balance completely paid back. It was 5 years down the road, and we ended up having $127,000 at the end of us repaying the loan. So if we do some simple math, we can find out that $127,000 minus $102,000 is $25,000. So what this tells me is that the cash value increased from before we took out any money to when we were done paying it back. We actually made an increase of $25,000, but yet how much did we pay in interest on the policy loan? We only paid $11,000 of interest. So we paid $11,000 of interest for the policy, but we earned $25,000 of interest inside the policy. I don't know anybody who would say that's a bad gig. In reality, we made essentially a $14,000 profit, or $14,000 more than what we paid inside this policy. And this assumed we borrowed every penny out. Why is this? How does this work? How do we get so profitable? Well, there's a couple things going on. As we mentioned to start with, we had $102,000 of cash value. When I took out that $100,000 loan, I was still earning interest and dividends based on the full $102,000, even though that money wasn't even in my account, you could say. I mean, it was because I used a loan against it. But in other words, the values, the growth of the policy was exactly the same in this instance, regardless of the loan or not. So I was earning money on the entire balance the whole time. And on the flip side, I was paying back my loan balance. And so when I was paying back the loan, you can see the loan balance decreasing each and every year down to 0. And so not only I was earning money on $102,000 plus, compounded over those 5 years the entire time, but I was only paying interest on what I actually owed to the policy loan. So I had the loan balance was going on an ever decreasing balance, while the cash value was going on an ever increasing balance. And so there's always going to be a crossover point there. So we made about a $14,000 profit doing this. Or if you want to run through the math again, if I take if all we do is simple arithmetic, and I'm going to take the $102,067 that I had in my cash value before I did anything, and I went out and I took a $100,000 loan. So if I take minus $100,000, that means that there was really $2,067 left in the policy. And then what I'm going to do is I'm going to add back that $111,000 and some change that I paid back in over the next 5 years. And that really would tell me my balance should be, if all we do is take out what I had, subtract out what I took out, add back in what I took in, I should have $113,000. If I had $113,000, then I would have gotten, I know I would have been able to get back all my principal and all the interest that I paid on that loan. However, I'm at 127. That's the $14,000 gain above and beyond the principal and interest that I paid that I was able to earn in that policy. And so and by the way, one more question that you may have had is, you'll see the very first year the loan balance only says 82,000 and not 100,000. Remember, it's hard to illustrate it perfectly. In other words, these are all end of year numbers. None of these are beginning of year. So what happened was I went out and I took out a loan of $100,000 and I paid back $22,213 that year. So at the end of the year, the balance was 82. It started at 100, but I also made loan repayments that year as well. So that's why you don't see the number $100,000 there. You see what it was at the end of the year after making the payments to it. So this is just trying to isolate as best I can what a policy loan looks like, how it works, showing you the real numbers behind the scenes inside this policy illustration of the growth of the policy over that time, growing by 25, us paying 11. Because some people wonder, well, why on earth would I ever want to pay interest to the insurance company? Why would I ever want to use it? Well, the question is not whether you want to pay interest or not. Remember, you could have withdrawn the $100,000 out of this cash value. You didn't have to borrow against your cash value. You could have taken a withdrawal instead. But then what would have happened to all the numbers? They would have all been $100,000 less, and the growth would have been on that money. So in other words, you could take out the loan and have it earn and compound the entire time, or you can take the withdrawal and have to start back over and build it back up and keep doing that over and over again, which is why we suggest doing the loan, because you can make profits based on the arbitrage that the loan interest is going to be decreasing while the cash values are going to be increasing. You can always make money. So remember, you finance everything that you buy in reality. You can either pay cash, that would be like withdrawing money out of your policy to pay cash, or you can borrow against it to purchase it. And typically the loan portion is going to produce more and better results for you than the withdrawal portion. So this is one way to do it. But if you've been around us for any period of time, you've also heard us say that not only should you pay the insurance company back the interest on the loan, just required to pay back the policy loan interest rate, but why don't we pay ourselves back a higher rate of interest than what we're being charged? And I'm going to pull up the same exact policy. I'm going to flip over to the next page. I'm going to pull up the same exact policy, but there's going to be one change, and that's going to be how much we're paying back to the insurance company. So you can see why we say, hey, maybe the policy loan rate is 5% at the insurance company. Maybe that's what it is. But why not pay yourself back 10%? And so I want to show you how that works and how that changes things in your policy. So remember, this is the same policy, $15,000 of premium for those 7 years. You'll see the cash value is at $102,067, exactly the same as it was previously. We start taking out $6,000 a year starting in year 8 to pay the premium. Everything is the same. We take out the same loan, and the same loan balance is being paid off. If you remember, it was over 5 years. We took out $100,000. We paid back everything the exact same. The only difference is that now in this total annual outlay column, that's how much money is actually going in, and how much you're taking out kind of gets isolated in this column. You'll notice that instead of it being the $22,213 a year payback that it was previously, we went up, and now we're actually paying back $25,000 a year into the policy. This is just an easy way for me to show kind of paying us back extra interest. So if all we were going to do is pay back the $22,213, we made a $14,000 profit. We were doing pretty good. Now what I did is, hey, how about we pay ourselves back extra money into the policy? Instead of just paying back the policy loan plus the interest due, what if we just round it up and say, I'm going to pay not $22,213. That's what I need to pay back the policy loan by itself in 5 years. What if I wanted to add extra during that time frame and pay myself, maybe it's 10% or 12% interest instead, and I just rounded it to nice even $25,000 per year to pay back in. Once again, by the way, year 8's a little bit funky, remember, because we took out a $100,000 loan and we paid back in $25,000 that year. So it's like a minus $100,000 and a plus $25,000. You get the negative $75,000 that you see in year 8. And so once again, just wanted to remind you where that math came from. And so what I wanted to share is something over here as well, as you'll see that the premium that used to be $6,000 ongoingly, that we were using those paid up additions withdrawals to pay for just so we could isolate the loan, we actually increased it from $6,000 to $8,787. What that really was is we added $2,787 to the payment schedule. That's how you get that exact number. Remember, the $22,213 was the amount of money we were paying just to pay the loan back. And to get to $25,000 input, we had to add $2,787 to it to get $25,000 per year going back in. That actually went into your paid up addition, your PUA rider. And that's how you add this extra interest. When we say pay yourself extra interest, people are like, okay, do I just make a check out for the loan repayment for extra? No, what you would want to do is do exactly what I've done here, is essentially make the same loan repayments of $22,213 back into your policy, but the extra interest actually needs to go in to your policy via a premium, and the most flexible form of that would be your paid up additions rider. Once again, I told you as a warning, this is more of an advanced webinar, I guess you could say, because at the very beginning I mentioned there's going to be some terms I'm going to use that if you're not super familiar with it, it might be confusing to certain things. So the paid up additions rider is like the cash rider. It's how you stuff extra cash into the policy. And so that's where I fit in the extra interest that I wanted to pay. And so over this course of time, if we get back to the example, we paid back the loan the same pace that we were paying it back previously with the same numbers. We added extra in, we paid ourselves extra interest, and you'll notice that the cash value increase this time was from 102 to 142. Last time, if I flip back over to the previous page, just to remind you, we had 127,000 of cash value whenever I was done paying back the loan. This time we have an extra, we're up to 142,000, or we've got $15,000 more in cash values by paying extra interest to ourselves. Unlike the loan previously, so let me backtrack one moment. Unlike when you take a policy loan and you pay it back, it doesn't actually impact any of the numbers inside your policy. In other words, if all you were to do is take out a $100,000 loan and pay it back to the policy, your policy would grow exactly the same way as if you hadn't even taken out the loan. But by taking the loan, you're not going to improve the policy itself. The loan by itself does not improve the policy. It's the extra interest that does. So the policy itself was going to have $127,000 in year 12, regardless if we took a loan out and we just paid back the loan interest rate that they had. In this case, we added extra money, which of course it's going to change everything in this policy. From now until the day you die, your policy is going to be better off than it ever would have been had you not paid yourself back with the extra interest. In other words, in this case, we paid back in a total This time was $125,000, and that's simple enough. I don't even need a calculator. That's just the $25,000 a year for 5 years. So technically, this year, this example, we paid back $25,000 of interest. The time before, we paid in $11,000. So we paid back $25,000 of interest, but the cash value grew from 102 to 142, or it grew by 40,000 from year 7 to year 12 over those 5 years. And so we got back, of course, all 25 in interest that we paid plus $15,000 of profit, which is higher than last time. We made $14,000 without it. But I wanted to share something that I think is really cool by having done this. And whenever we talk about this, we say not only do you, of course, get more money because you paid more in, but you change your policy. Your policy is going to be different. It's going to be better than if you hadn't done it this way. And what I mean by that is you can tell just by looking at the dividend column that's being earned right here. You can tell just by looking at it that this policy is now improved in many different ways. The obvious way is we've got $15,000 more in cash value, which I've already mentioned. We had $127,000 when we just paid the loan back. Now, of course, we've added more premium into it. We've got a lot more cash value. But on top of that, you'll notice that the dividend, let's just use year 12 as our guideline. Year 12, the dividend in this example, when we added the extra interest to our policy, is $23.37 this year. $23.37. If I flip back to the previous example, you'll see that the dividend in that same year 12, the year that we got done paying it off, was only $2,081. In other words, not only is this policy going to be changed, the dividends are going to be much higher for the rest. That's almost $300 extra in dividends we received that year. And the dividends ongoingly are going to be a lot higher. In other words, if we scroll down and just look at year 25, let's say, this was the example that we didn't use any extra PUA. You'll see $5,700. Look at the dividend. If I go here and go down to page year 25, just like the last one, the dividend is $6,200. So throughout the rest of the policy, you got $6,200 compared to the $5,700. Throughout the entire life of the policy, when we add the extra PUA rider into it, we're going to be earning more money in dividends alone for the rest of the life of the policy, just based on what we've done. You also, of course, the cash value at year 25 without using the PUAs and paying extra interest was $235 compared to what it was with PUAs was $264. That's almost a $30,000 difference in cash value over that time period. You also see we had $729 in a death benefit at year 25 when we paid ourselves extra interest. And when we didn't, in that policy, it was $670. That's over $50,000 more. In other words, I'm going through all these numbers simply to share with you. This is why we are so adamant that it's great discipline to start paying yourself extra interest on the policy loans. It doesn't matter if it's a lot or a little, but you'll see drastic changes over time. Instead of just paying the loan back at the schedule that the insurance company, or at the interest rate that the insurance company requires to pay it off, it's on your own schedule as far as how long or quickly you pay it back. But as far as interest rate, if you pay yourself extra, what you're going to do is the dividends, the cash values, the death benefits, everything in your policy is going to increase. Of course, with the more interest that you pay back to yourself and add to that paid up additions rider. So this is what I wanted to share, the two sides of it. One, just assuming we only paid back the interest that the insurance company requires. The other one, of course, assuming that we pay it back and add the extra interest that we suggest you do. A couple things to note, by the way, in all of this. A couple things to note. First off, not every insurance company has what we would call a flexible paid up additions rider. In other words, not every policy that's out there has the ability for you just to add extra PUAs into your policy. Sometimes if it's set from the very beginning what you can pay into it. Sometimes you can maybe add 3 extra payments into it, or a certain number of unscheduled premiums into it. Sometimes you can put in any number. So just keep that in mind. It's not the end of the world if it's not. I have a lot of policies that don't have flexible PUA riders. So to add the extra interest, what you may have to do is start accumulating the extra interest that you're paying on all your loans and use that to just start a brand new policy, which essentially is going to have the same effect as just adding additional premiums into this policy. It doesn't matter if it goes into a new policy, a separate policy, or the policy you borrowed from. The key is just getting in the habit of paying yourself extra interest. So I wanted to make that note that not everyone has the flexible paid-up additions rider on the policy, or at least very flexible. And you also, when you're paying an extra PUAs, you always have to keep in mind that there's a MEC limit on the policy, which I'm not going to get into a lot of detail again. But for those of you who are kind of new, there is a maximum limit on your policy of how much can fit into the premium without the policy going into MEC status, MEC, MEC. And so if the policy goes into the MEC status, it becomes taxable. It's not taxed as life insurance anymore. So there's an IRS, imposed limit on each policy when it gets started. So you can't just go out and say, I'm going to pay myself $50,000 of interest this year, extra interest on a $15,000 a year premium policy like the one on here. That would MEC the policy. So there's going to be some limitations. That's why your IBC system was never meant to be fully accomplished with just one policy. It can't be done if you do IBC properly. You can't do it with just one policy. You're going to need a system of policies. I would also want to mention another fact that not every company is what's called non-direct recognition. And in other words, there's two types of insurance companies on how they measure dividends. One is called direct recognition. One's called non-direct recognition. The non-direct recognition is typically the preferred way to build dividends, because whenever you take a loan out, you get the exact same dividend that you would have gotten had there been no loans on the policy. The non-direct means they don't recognize dividends, and they don't recognize loans, excuse me. They don't recognize loans when they account for dividends. A direct recognition, when you take loans out, will change your dividends. Sometimes they'll boost your dividends. Sometimes they'll reduce your dividends based on kind of the interest rate environment at the time and what's going on. That's not the end of the world. In fact, Nelson Nash, when he wrote his book, used a direct recognition company to write Becoming Your Own Banker. So some people think it's a make or break thing. I definitely don't. I think it works well with both. You just have to keep that in mind, that your dividends may change if you take loans out. But I've got a lot of direct recognition policies myself that work really great. So don't let that, don't let the nickel hide the dime, that you have to look at the overall picture. So that's really the main gist of what I wanted to do with some disclaimers. I hope this was helpful to you to see a real policy with a loan being taken out, being repaid with interest, knowing it is true, we paid interest on this policy loan that just went to the insurance company. But the question is, did the growth overtake it? And the answer is yes, for a couple of reasons, which we mentioned. The ability for the policy to continue to earn money on 100% of the account value, even when there's a loan outstanding on it, as well as the fact that the loan is being the loan is being repaid, and so the interest is getting lower and lower while the cash value is growing on an ever increasing balance. So you can always make money on that. So I also wanted to add in there the addition of the extra interest to going into the PUA rider, how that works, so you can see the benefit for doing so. Of course, increasing the cash value, increasing the death benefits, but also just seeing over time. It's not just isolating, if you paid back a loan, what's the difference in that little 5-year time frame? It's what happened inside your policy for forever. That's a huge difference. And so that's why we encourage you to get into the habit of paying yourself extra interest, finding a way to get that into the policy through the PUA rider. And if it can't fit or the flexibility isn't quite there, then open another smaller policy to hold it. And so those are great disciplines to do that. If you have questions, you can always email me. I'm happy to answer questions via email. You can reach me at nate@livingwealth.com. In fact, I'm going to open up the questions here. I don't know if it's available right now. I just opened it up on this deal. I think you can ask questions. If you'd like to email me a question, feel free, nate@livingwealth.com. Very simple. If you have some questions, you can feel free to answer them now, but it's been great going through this with you. I hope you enjoyed this conversation. I'm done as far as what I had to cover today. I know it's probably just the tip of the iceberg. I may have confused you more than I helped you, and I apologize to do that. But I hope that it was helpful for you. One question is, how do I add to the PUA? How do I add to the PUA? You add to the PUA, first off, you want to call us in our office, and so we can get in contact with the insurance company and make sure that your policy doesn't mech. If it does mech, then we can't add to it. We want to switch it to where we can go into maybe another policy or something like that. So when you add to the PUA, you can either send in a check directly and just mark it out for PUA once we know if it mechs or not, based on the amount that you want to do. If you are on a monthly policy, you can also increase the monthly draft. We got another question. Where on the chart does it show the $6,000? I don't know what that means. I'm guessing you're talking about the premium, and I covered that. The premium is being covered by paid-up addition surrenders, which is a withdrawal from the policy. And so we're taking that out of the policy and a withdrawal to pay it. We have another, is interest paid to a life insurance company tax deductible? Great question. So on this example, we didn't really bring in any tax issues. If you personally take out a loan for a personal use, then it's not tax deductible, but it can be tax deductible if you're using it for business or investment purpose. So if we go back in there and we assume we took out the $100,000 to buy equipment at your business, or maybe purchase a rental property or invest money in one way or another, then we can go out and deduct that interest, just like we could have deducted the interest if we borrowed it from another source. So essentially the rule of thumb when deducting interest is if you were to borrow money to purchase whatever it is that you were trying to purchase, if you were to borrow money from another bank, just a random bank, if it's deductible to you to pay them back in general without the policy or anything, then if you use the policy to purchase that same asset or that same whatever it is, same car, whatever it is, if it was deductible without the policy, it's deductible with the policy. But if it's to pay off a credit card or to buy a personal car or to go on a personal vacation or something like that, personal use, just like credit card interest is not deductible to an individual, a private loan to an individual is not deductible, then a policy loan is not. But if it was used for business or investment purpose, it would be deductible just like if it had been from someone else, regardless of the policy. We ask, what if we don't pay the loan back to the insurance company, but instead pay back to ourselves in a personal account? Another great question. A lot of times we have people paying back into a segregated account or a separate checking account, not directly back to the policy. Just know in that situation, you don't always want to keep all the money in the segregated. The segregated account or the separate checking account, typically that's used for kind of like a short-term holding tank, quarterbacking the system. But at some point, it doesn't have to be right away, but at some point you'll want to get the money back into the policy and not just let it sit in cash. All right, that looks like it's the end of the questions. If you have anything else, feel free to email me, and I'm happy to answer them. I hope you enjoyed it. I'm going to go ahead and close it down. Thanks for being on the call, guys. Bye-bye.